increase your portfolio return without taking more risk or really even changing your overall portfolio allocation. In today's video, we're going to talk about how putting the right investments in the right accounts can increase your after-tax growth rate by as much as 0.5% per year. Let's get into it. Now, first off, let's talk about what this strategy is worth before diving into the specifics. The strategy we're going to discuss today is called asset location. Asset allocation describes what investments you will hold. Asset location describes where you're going to hold those investments. Over the past decade, there have been numerous papers trying to nail down the exact expected improvement from asset location. One study found the improvement to be as large as 0.5%. Another found a lower amount at only 0.23%. The tough part here is it can vary widely person to person. For the sake of this analysis, let's say asset location is worth 0.3% to you. Now, 0.3% might not seem like much on the surface, but keep in mind these returns compound. If we took $1 million growing at 8% for 30 years, the difference in ending values would be over $800,000. So small improvements can really add up over your retirement. The reason this strategy exists is because each account that you have in retirement has a different tax consequence. If you adjust the location of your given assets to optimize for these tax consequences, there will be benefits. The first two accounts on the screen, a Roth IRA and a traditional IRA, are both considered qualified accounts. Any income or interest generated within these accounts is contained within these accounts. It does not pass through to you on an annual basis. You really only have tax consequences on contribution or withdrawal when we talk about these accounts. With a Roth IRA, you pay taxes on the contribution, but then never pay taxes again. All growth is tax-free as well as the withdrawal is tax-free. A traditional IRA is basically the opposite. You get a tax deduction on the contribution, but then you owe taxes anytime money is withdrawn from this account. A taxable account is quite different from these two accounts because you are taxed any time income is generated. Dividend income and interest income will be taxed annually within these non-qualified accounts. As a general rule of thumb, with all three of these accounts, we want to try to minimize forced income if we are tax-conscious investors. Forced income means forced taxes, and we really want to have as much control over our tax situation as possible. Traditional IRAs and taxable accounts both have forced income, but in different ways. IRAs have forced income in the form of required minimum distributions that take place in your 70s. Taxable accounts, as we just discussed, have that forced income on an ongoing basis due to dividends and interest income. Now, through these three accounts, there are potentially 4 tax tables that you are subject to. Now, Roth rates aren't really a tax table, but nonetheless, I wanted to bring them up on the screen because obviously you can withdraw tax-free and there are no limits. You could theoretically withdraw $1 million from a Roth account and pay nothing on the tax side of things. On the left-hand side of the table, you should be pretty familiar with traditional IRA tax tables. Anytime you pull money from traditional IRAs, you are taxed at ordinary income rates. These are the same rates you would be taxed at for your normal working income. It's the taxable account rate table that gets a little bit complex. First, we have long-term capital gain rates. These are preferred rates that ideally, if we're taking income from that taxable account, we want to be subject to these long-term capital gain rates. Now, if you look up long-term capital gain brackets online, you're likely to see there are only 3 long-term capital gain brackets, 0, 15%, and 20%. Yet on the screen, you'll see that I have 4 layers of long-term capital gain rates. And as with most things with the US government, things are more complex than they first appear. It's worth noting that there is an added 3.8% net investment surtax that will be applied to all capital gains, long-term and short-term. If for a married person, you are showing an AGI, an adjusted gross income over $250,000, and for a single filer, that AGI over $200,000. And again, this is on all income, interest, dividend, or capital gains generated from that taxable account. So it creates an 18.8% zone and a 23.8% zone as well. To the right of that, we have short-term capital gain rates. These rates are the same as ordinary income rates, plus that 3.8% added surtax on the upper end of that table. The point being, there is a big gap between long-term and short-term rates within that taxable account. Keep these tax implications in mind as we continue to flow through this video. Now, a big and common mistake that I see a lot of retirees make is that they take a given asset allocation like a 60-40 and they simply allocate equally in each account, 60% stocks and 40% bonds in the Roth, in the IRA, in the taxable account, and so on. This seems to make sense on the surface. We at the end of the day, want to balance out that growth and safety. But deeper consideration would show us this is quite tax inefficient. For instance, unless we are withdrawing from that Roth in the short term, we really don't want bonds or lower growth assets located here. We want as much growth as possible within this account because it will be tax-free growth. Similarly, we don't want bonds in the taxable account because there will be forced income. Remember, interest is taxed annually and at short-term capital gain rates. So it's taxed at that higher rate table. What we ultimately want to do is we want to look at the tax implications of each investment and then locate those investments accordingly. Now, this seems relatively simple on the surface if we just look at the tax efficiency of each given investment. But no, there are deeper layers of decisions that need to be made. For instance, let's say we looked at this chart and just in our overall tax picture, we needed to pull from our taxable account first, and so we needed safety within that taxable account. So we might conclude that, hey, anytime we're putting bonds within our taxable account, we should be using muni bonds instead of taxable bonds like treasuries. Well, say a treasury bond right now is paying 5%, and a muni bond is paying 3%. Well, the muni bond might be tax-free, but you earn quite a bit more in the treasury bond situation. The case can be made the treasury bond is far more safe as well than a muni bond. For the muni bond to make sense, you would have to be taxed at more than 40% on that treasury bond to get the essentially same tax equivalent yield as the muni bond would have. If your tax rate is less than this, then even though it might not be preferred, we might need to put that treasury bond inside of that taxable account for withdrawal reasons. And again, the larger interest that is generated at the end of the day, again, if we're not taxed at that higher rate, would make more sense. We'd get a higher after-tax yield. So as we think about each investment and where to place it, we need to be thinking about the tax implications, but also growth and safety expectations. You should also be thinking about your withdrawal order. We might find tax-wise that we don't want any bonds in a taxable account. But again, we might need to put some safety there if that is the first account we are pulling from, and we need to maintain the value within that account for reasons like planning for Affordable Care Act insurance or something like that. Another layer to this discussion is our ability to break down investments into smaller parts. Again, take that 60-40 portfolio. Well, how is that 60% stock allocation invested? Sure, we could just use a total stock market fund and just have one fund that we invest in. But this, once again, won't make as much tax sense. Instead, a total stock market fund could be broken down into small cap, mid cap, and large cap investments. Further, we could break down into value and growth stocks within each of those sub-asset classes. In each category, we can see different tax implications. Value stocks tend to have larger dividends versus growth stocks. So logic would follow that we'd want to place growth stocks within our taxable account and then position value stocks within our tax-protected accounts. This type of splitting is called yield splitting and can further allow you to have control over that asset location strategically. The same can be done with bonds as you break down into long-term versus short-term bonds, higher yielding, riskier bonds versus lower yielding, safer bonds. In tax-protected accounts, dividends are irrelevant from a tax standpoint. If you have a dividend in an IRA, that dividend is only taxed when you withdraw the money. So there isn't an annual cost to that dividend income within the IRA. In a taxable account, however, that dividend can be quite costly, whether you use that dividend for income or you just simply reinvest it. This is surprising to most, but let me explain. First, if your taxable account generates $20,000 in dividend income and you're just simply reinvesting that income, then dividends cause a tax drag. If you're in a 15% bracket, you now owe $3,000 in extra taxes. It's not only $17,000 of those dividends are going to be reinvested on your behalf. This tax drag adds up quite a bit over time unless you are able to maintain that 0% dividend tax rate. But what happens if you live on the dividends? Then there should be no tax drag, right? Well, wrong actually. Say we have $1 million taxable account with $500,000 in cost basis, and we're comparing a given stock position with a 3% dividend yield, and we're comparing this to selling 3% of another stock position that doesn't have any dividend. Obviously, the gross income will be the same, $30,000, but there is a gap in the taxes owed and therefore is a gap created elsewhere. Taxes on selling stock are less because part of what you sold is going to be cost basis, where the dividend will be fully taxable. This leaves you with less cash flow with the dividend, causing you either to sell stock anyway or live on less. Ending portfolio is the same, but the cost basis now changes. The cost basis in the case of selling stock is more preferred because let's say this person passes away the following year. Well, their heirs are going to get a step up in basis, thus wiping out the unrealized gains within this account. And so deferring taxes inside of a taxable account and building up more in unrealized gains generally is more preferred over the long term. Further, when we consider where we want the most growth, like in your Roth IRA, so we have tax-free growth, we need to further consider performance expectations. If we use history as a guide, smaller companies have durably outperformed larger companies. Smaller companies tend to have a bit more volatility, but you're ultimately paid for that volatility over the long term. So it would reason that if we believe this trend will continue, we should locate smaller companies inside of the Roth IRA because they will be higher growth assets. If we want to minimize RMDs, we might consider locating safety inside of our traditional IRA, as slower growth will help RMDs grow more slowly. Ultimately, these ideas stack on one another and give us a rough map for tax location. Now, the reason I say a rough map is because the best asset location for each person's situation can vary quite widely. For example, say you don't have a Roth IRA and you just have a traditional IRA and a taxable account. Well, that will lead to a different tax location mapping than someone who has, let's say, all three accounts. Say you are someone who is on Affordable Care Act insurance and are trying to keep their income low to earn a larger subsidy. You might need to put safety inside of your Roth IRA because you need to withdraw in the short term from that Roth IRA. And so that will lead to a different asset location than someone who is 65 and on Medicare and wants to be as aggressive as possible with their Roth IRA. But in general, you want to allocate higher growing assets like small and mid caps into your Roth for that long-term tax-free growth. Now, it's completely fine to have large cap or international in the Roth. We just want to tilt towards more growth at the very least. Then in your taxable account, we want to have low dividend stocks like growth stocks. If we hold bonds, we want to use potentially muni bonds or using short-term lower yielding bonds. This is an account you're generally going to be withdrawing from first, so shorter term safety matches up with our general goals anyway. Then often the traditional IRA tends to be more of a quote unquote cleanup account. Generally, we want to have the majority of safety located here. It is likely the second account we pull from. The safety helps to minimize RMDs as well as previously discussed. All in all, asset locating in this fashion can be worth anywhere from 0.1% per year to over 0.5% based on your situation. Based on research by Vanguard, Morningstar, and then our team here at Safeguard, a reasonable after-tax improvement expectation should be anywhere from 0.15% up to 0.35%. Again, this is without changing the risk or allocation of your portfolio. Then finally, to close with some additional considerations on this topic, there's been some recent disagreement on the best place to put international stocks. Now, based on the logic that I painted so far, international stocks tend to have a higher dividend yield than US stocks. So one would think that we should place those international stocks within tax-protected accounts. But here's where the complexity comes in. Many countries tax dividends before they are released to you. For instance, let's say that we have a company with a 4% dividend yield and it's located in a country that taxes dividends at 15%. Well, that country will basically take that 15% right off the top before you receive the dividend. If you hold this stock in an IRA, well, then you get no tax benefit for that dividend, or the dividend tax is already paid to that foreign country. If you hold that stock within your taxable account, you actually get a credit on your 1099 for foreign taxes paid. This can lead to offsetting some of the dividend tax bill charged to you inside of the US here by the IRS. So some make a case that you should hold international stocks in a taxable account for this exact reason, and there's validity to this argument. If you are holding individual stocks, I think this case really is valid. But when you are holding a large international index fund, there will be some companies within that fund that are in countries that tax the dividend aggressively and others that may not tax that dividend at all. So the large dividend tax drag associated with international stocks is only marginally improved. Further, that dividend tax bill might be minimized because of the foreign tax offset, but the gross amount of your dividends still counts against you when planning for tax hurdles like Medicare's IRMA or planning for things like Affordable Care Act insurance. So my opinion on international stock placement is that it depends highly on the person's situation and how they are investing in international stocks. Now, I know this was a bit heavier of a topic today as we are dealing not only with the complexities of the US tax code, but also the complexities of given investments, the structure of those investments, and how they best fit together to build a long-term tax-efficient portfolio. The point is asset location matters. and can give you a significant advantage without changing your portfolio allocation and with really no underlying performance change. Reach out to our team down below if you'd like help building a more tax-efficient retirement. Further, if you'd like to learn about more tax strategies, like which retirement account you should pull from first in retirement, click on this video right here to learn more. Always remember, you don't need more money, you need a better plan. Thanks for watching today.